Let's discuss the rewards of diversified portfolio investing for the conservative investor. We are trying to build the best investment process we can, one that balances and quantifies both risk and return. If you are not quantifying risk, you are likely taking too much of it. We do this not by guessing. We do this by studying Nobel Prize-winning theories, hundreds of historical data series covering thousands of years, and math, marrying theory and facts. Note that all information in this presentation has been adjusted for inflation. We do that because we believe conservative investors are trying to preserve the purchasing power of their portfolios. That's why we want to judge conservative investing based on how it does preserving purchasing power. Here we see a risk and return chart from 1970 to 2016 with average annual returns going up and down and risk going across horizontally. We show the asset classes that conservative investors are usually thinking about: U.S. bonds, international bonds, gold, and municipal bonds. What we find interesting is this blank white space. This is the low-risk, high-return space, and the world doesn't often want to give away low-risk, high-return investments. When conservative investors look at a chart like this, what they'll often do is start at the opposite end. Most conservative investors don't want high-risk options like gold in their portfolio. Then, investors will look at this international bond space, and they'll say, well, it had higher risk and higher returns, but that's not the game they're trying to play. They're trying to play the lower risk game. So most conservative investors won't own international bonds. A lot of conservative investors will be interested in municipal bonds until they see this chart, with the data here showing much lower returns than traditional U.S. bonds, so we'll go ahead and cross that out as well. But let's step back for a minute, and let's look at U.S. bonds and gold since 1970. The question is, what would happen if you put 70% of your money in U.S. bonds and 30% in gold? Now, most people think if you put 70% of your money here and 30% here, you'll be right here. But what actually happened is U.S. bonds and gold had low to negative correlation over this period. When one was going up, the other was often going down. So if you put 70% of your money here and 30% here, you would actually have ended up right here. You would have had less than 4% more risk for greater than 23% more returns. Even conservative investors can get behind something like that. Thus, if you embraced global diversification over this time period, you would have had both lower risk and higher return than the 10-year U.S. government bond. Here's the data behind that chart we just saw. That diversified portfolio would have had the highest average annual return and the second lowest risk, leading to the largest Sharpe ratio. Looking at the average annual returns for a moment, and skipping municipal bonds, the average return of these three asset classes was 3.86%, yet that diversified portfolio would have averaged 4.46%. Well, two men, one by the name of David Booth, his name is on the Chicago Business School, and another by the name of Eugene Fama, he won a Nobel Prize, they looked into this, and they called it diversification return. It's the extra return you get merely by combining assets with low and negative correlation and rebalancing. Let's look at the 10 worst calendar years from 1970 to 2016, and this is how we read it. We start on the left with U.S. bonds. This is the 10-year U.S. government bond, a perfectly fine asset class, but after inflation, it had many down years, so many we can't even fit it on this chart. This is likely surprising to conservative investors. International bonds, same situation, many negative years. Muni bonds and gold, again, many down years. That diversified portfolio, while it certainly had its share of down years, quickly gets to a point where the down years are very tolerable to conservative investors. Diversification is very robust. Now, we don't think the past 47 years are going to look like the next 47 years, so we chop data up into rolling 10-year data points. Here's what we mean by that. If we start in 1970, the first 10-year period goes from 1970 to 1979. The second 10-year period goes from 1971 to 1980, etc., etc. There are 38 different decades we can look at. When we look at U.S. bonds, here's the long-term average, but then we get a very, very wide range of outcomes over 10-year periods. That diversified portfolio had a much tighter range of outcomes. And if we strip away all the dots, here's the range of outcomes. We believe conservative investors would be better served shooting for a smaller, tighter range of outcomes. We could then blow those dots up to get a better picture. We believe this is a choice that conservative investors get to make. Do they want to choose U.S. bonds for their conservative portfolio, or do they want to embrace global diversification? Let's chop the time frames up into even shorter periods. And here's 5-year periods, again taking away the dots. We believe conservative investors are better served with a tighter range of outcomes. And again, we can blow those dots up, and this is the choice that conservative investors get to make. Finally, let's look at 3-year periods over even shorter periods of time. Here's what the range of outcomes looks like. And again, we can blow those dots up. Moving on to more of the process, the first thing we look at is global GDP. This gives us an indication of size. We then look at world public debt outstanding. We underweight heavily indebted countries, and we overweight under-indebted countries. And then we look at world M2 money supply, and we underweight or overweight based on currency valuation. As an aside, we compare this to the SDR. This is the IMF's special drawing right. Many people say this is the currency of the future. What's interesting is when you look at the US dollar exposure of our portfolio compared to the SDR, it is very similar. Rolling everything together, here's the debt exposure of our currency portfolio. Note this is not current and subject to change. Everything here is based on our mathematical process. We have exact reasons for wanting to own every single slice of this pie. We are not guessing. Here's our disclaimer and confidentiality, and our asset class references and disclosures. Feel free to reach out to us to discuss this in more detail.